Over the past few days, a wild theory has been gaining traction across the crypto community. It suggests that Iran might be using nuclear-powered Bitcoin mining to secretly convert energy into untraceable money. Money that could be funding military operations, possibly even weapons purchases. Now, the spark for this speculation came from an X-post by Sage Mudir on June 22nd. In it, he claimed that a sudden drop in Bitcoin's global hash rate down to around 693 exahashes per second coincided suspiciously with the US airstrikes on Iranian nuclear facilities. The implication that Iran was using nuclear energy to power large-scale Bitcoin mining, and that the bombing disrupted this activity, causing the global hash rate to dip. It's the kind of post that went viral instantly. Part conspiracy, part geopolitics, and entirely crypto. But is there any truth to it? Let's start with what's possible. Iran has long been involved in Bitcoin mining. Since recognizing it in 2019, the country has used Bitcoin to bypass international sanctions, much like many other countries, especially as its access to the global financial system has been restricted. According to blockchain analytics firm Elliptic, Iran accounts for around 4.5% of global mining activity, using subsidized energy that makes this process extremely cost-effective, sometimes profitable, even when Bitcoin drops as low as $1,300 per coin. Now, with prices now well above 30,000, we're sitting at 100,000, that mining remains very lucrative. One notable example comes from Rafsanjan, where a 175 megawatt Bitcoin mining facility has been linked to the Islamic Revolutionary Guard Corps and Chinese investors, according to a report published by NCRI in May of 2025. Now, that's serious industrial capacity, and it shows that mining is more than just a side project for Iran. It could be a strategic financial tool. Now, the theory that nuclear power is fueling some of this activity isn't entirely far-fetched. Nuclear energy could theoretically provide the kind of cheap, dense, and uninterrupted power supply that large-scale ASIC miners need. But there's a big gap between possibility and proof. So far, no public documentation confirms that nuclear reactors in Iran have been tied into Bitcoin mining infrastructure. More importantly, the timing of the hash rate drop doesn't quite support the bombing theory. The decline was gradual, not the kind of sharp, instant vertical drop-off you'd expect if a major mining farm suddenly lost total power from a missile strike. And then there's the tone of the original post. It's sensational. Phrases like "holy bleep" and "extremely bullish" are designed to go viral. And in crypto, where clickbait often passes for journalism, it's important to consider whether this is genuine analysis or engagement farming designed to ride a wave of geopolitical anxiety. Now, here's where things get more subtle and more dangerous. Whether or not the Iran mining theory holds water, narratives like this do have real consequences. They're not just conversation fodder. They can be used to justify tighter surveillance, push for invasive regulation, and reshape the way the world views Bitcoin. Let's break this down. Stories tying Bitcoin to sanctioned states like Iran play directly into the hands of regulators and compliance advocates. They give ammunition to those arguing that Bitcoin needs to be watched, tracked, and controlled, because if bad actors are using it, then clearly the only responsible solution is to monitor everyone. That's how the pitch goes. This is where know your customer and anti-money laundering laws come into the spotlight. On paper, they're about stopping crime. In practice, they erode privacy and put a target on the back of every user, even you. Now, here's what that looks like. Now, if Iran is mining and selling Bitcoin, and that Bitcoin ends up in circulation, could exchanges flag it as tainted? Could regulators start pushing to trace coins across wallets and blacklist those linked to unauthorized sources? Suddenly, the idea of Bitcoin being fungible, that one Bitcoin is equal to any other Bitcoin regardless of the previous owner, starts to break down. If coins can be treated differently based on where they came from or their spending history, then they're no longer equal. And that opens a door to censorship, seizure, and control. What makes this worse is that most people don't see it coming. Privacy isn't just about protecting criminals. It's about ensuring that innocent people aren't treated like suspects simply for using their money. It's about preserving freedom of association, freedom of transaction, and freedom from arbitrary interference. And yet, in response to stories like this, we see louder calls for regulation. Advocates frame it as safeguarding the financial system. But let's be honest, it often aligns with the interests of surveillance firms, regulators, and multinational compliance bodies like the FATF. These aren't neutral players. They benefit when privacy is demonized and when control becomes the default. Bitcoin Magazine pointed this out all the way back in 2020. The push for heavy-handed compliance doesn't just reduce crime, it reduces competition. It creates walled gardens where only the biggest, most compliant players survive and everyone else gets squeezed out. That is not free market behavior. So even if Iran's mining story is exaggerated or flat out false, its usefulness as a political and regulatory tool is very real. And that's the real danger. While the Iran story grabbed the headlines, the real picture behind Bitcoin's recent pullback might be much less sensational, but far more grounded in data. Let's look at a few credible alternatives that are backed by market patterns, energy data, and on-chain metrics. First up, Texas curtailment. This one's pretty straightforward. During periods of extreme heat or electricity oversupply, miners in Texas voluntarily shut down operations to help balance the grid. It's part of their agreement with the ERCOT, the grid operator. These curtailments are common during the summer, and they're often profitable for miners who get compensated to power down. That's pretty cool. Several analysts, including Will Foxley and Sage M, pointed out that a grid surplus occurred the same weekend the hash rate started declining. This timing lines up with the past curtailments we've seen, especially in 2023, when hash power dropped by 10 to 15% during similar heat waves. The key detail here is the gradual slope of the decline. If a nuclear site had been bombed, you'd expect a sharp vertical drop-off in hash rate. That's not what we saw. What we saw looks more like a controlled, region-wide throttle back in operations, not an explosion-induced blackout. Next, let's talk profit taking. Bitcoin recently touched resistance levels near $108,000 to $112,000. That's a psychological and technical ceiling for a lot of large holders. It's where the chart gets heavy and where traders often start taking profits. Sell pressure. And that's exactly what seems to have happened. Crypto quant data shows exchange inflows spiked, and there was a significant sell-off, about 30,000 Bitcoin, reportedly just a few days earlier. This is classic whale behavior. Accumulate on the way up, sell near resistance, repeat. We also can't ignore the macro picture. On June 18th, the Fed pulled back expectations for rate cuts. CPI data came in cooler than expected, and suddenly the market started pricing in higher for longer interest rates. That's bad for risk assets, especially Bitcoin. So between Fed messaging, shifting inflation numbers, and bond market volatility, it's no surprise that we're seeing a bit of a risk-off mood. Bitcoin is one of the first things to get hit when liquidity tightens. And then there's mining profitability. Recent adjustments to Bitcoin's difficulty level have made mining a little tougher. If electricity prices are rising, especially outside subsidized zones, some miners may have been forced to power down or liquidate to stay afloat. That also weighs on the price. Lastly, there's always the possibility of coordinated selling or even minor market manipulation. It's not a stretch. We've seen this before. Large players testing liquidity or triggering cascades through strategic sell walls. There's no smoking gun this time, but the setup does look familiar. Key resistance, bearish sentiment, and a crowd waiting for a dip to buy. So while the Iran theory is dramatic and headline friendly, the data tells a quieter story. Bitcoin's drop looks more like the result of grid dynamics, technical resistance, whale behavior, and macroeconomic shifts, not an international incident. The Iran theory is compelling on the surface, but it's built on circumstantial timing, not hard evidence. The hash rate drop? Gradual. The strikes? Unconfirmed in terms of mining impact, and the theory's most viral post, it's loaded with emotion and light on proof. If there's a takeaway here, it's this. In a space where narratives move faster than facts, it pays to stay grounded. Don't let sensationalism blur your judgment, especially when regulatory implications are at stake. Now, for those worried about Bitcoin's fungibility and privacy risks, consider diversifying your tools. Monero is amazing. Just a hint there. You can also learn how to use CoinJoin, get familiar with P2P trading and privacy-focused wallets like Wasabi Wallet for Bitcoin. These aren't fringe practices, they're safeguards. Keep an eye on grid signals, exchange flow metrics, and the upcoming PPI data. That's where the real insight lives, not in viral threads or geopolitical guesswork. And if you want to stay ahead of the noise with data-backed breakdowns like this one, you know where to go. learningcrypto.com. Stay informed, stay sovereign.